Hello, welcome. My name is Joshua Brown, and I will be your host today. And we're going to be discussing mortgage insurance or lender insurance with the bank or lender versus privately owned insurance. I'm going to be sharing the link at the bottom of this to a CBC documentary on mortgage insurance with the bank, the perils of that insurance. I myself have gone out to all of the big five banks, gone in, acquired the actual mortgage insurance booklet, read them. I've read all of them. It's allowed me to educate my clients on this subject over the last decade. My goal is to leave you today feeling very educated on mortgage insurance or lender insurance. And we're going to speak firstly to individuals. Then we're going to speak with corporate. So, what do I mean by mortgage insurance or lender insurance? Let's define it. What mortgage insurance or lender insurance is designed to do is that, heaven forbid, something happened to you before your planned death date or the date on our schedule to pass away. Some of us don't make that schedule. We die before that due to health reasons or accidents and whatnot. So if something were to happen where we were taken off this earth before our time, the mortgage insurance is designed to pay off those debts. They're more geared to protect the institution than the individual. So I'll give you an example. Let's say my wife and I, for example, are purchasing our first new home, very excited. Haven't had a child yet. We go into the lending office and they say, if anything were to happen to you, take this insurance right here and the debt will be completely free and clear. Sounds great. We take that insurance. A year later, unfortunately, I'm killed in a lightning strike. And my wife goes to the bank. She's been off of work for a couple of months and says, I'd like to continue the payments. I really need that money to pay for Josh's funeral and other expenses, maybe a vehicle that needs to be paid off. And what the bank will inform her is that you do not have any more insurance. As soon as your home was paid off, when that claim went in, then that claim was the basis of your insurance policy. And even though you had insurance as my wife, you do no longer have that insurance. And your husband, his insurance just covered the debt at time of departure. So if the debt happened to be half of what we initially took out, even though we're paying the same monthly premium, that's what that's going to cover. Now, the apples to apples comparison to that is my wife and I are purchasing our first home. We are educated enough to know that that's not the best option for us, but we take it initially. We take it initially because it's better than having nothing, and I would recommend people do that when they're purchasing a large asset, home, boat, condo, business. Take the lender insurance for now, and then what I'll do is should be able to get you something better. So then what I would do is after I've gone into the bank and picked up the lender insurance temporarily, I would now go into and meet with a life insurance agent, someone who's licensed, and I would purchase individual life insurance, typically doing a needs analysis. So maybe the need is a little bit more than just the debt. And that's kind of another topic. We're going to chat about that another day as far as a needs analysis. But let's just say just the debt that we're covering. My wife and I are both non-smokers. We get that insurance coverage, and a year later, heaven forbid, something happens to me. At the time we took out the mortgage, it was worth $500,000 debt. At the time of my death, $400,000 debt. And in addition to buying the life insurance, when we were in the office that day, we had a discussion around critical illness insurance or living benefits. So heaven forbid my wife and I get sick before we die, which unfortunately happens. then we have coverage there as well, not just death coverage. So just before I died, I unfortunately was diagnosed with cancer. And as such, for the diagnosis with cancer, we had a $200,000 critical illness. Again, this is all in a made-up story. And what happened was, in that scenario, is I acquired the cancer, I submitted a claim, I survived the survival period. This insurance is designed for if we're sick and we live. That's when the financial consequences kick in. And what happened is the $200,000 was paid out to us tax-free in one lump sum. We were able to use that. Just prior to me dying, my wife was diagnosed with cancer while I was dying. So I die. The $500,000 insurance that we had pays out versus the $400,000 balance. So we get my wife has the $500,000 payout, tax-free money in her hand. She can decide at that time if she would like to continue paying the mortgage, if she would like to pay it all off. What the bank, and I joke around it's the mafia, but what the bank mafia wants you to do is pay off your debt immediately when you've lost your partner. That may not be in your best interest. However, it's in the bank or lender's best interest. And the reason they do that is that if something happened to you or I, they don't want to be left holding home or property, paying the taxes, the water bill, the maintenance. So they came out with a clever product that protects the client and protects the bank. However, the way it's designed and just clearing the debt is it protects the bank more than it protects the client. And if you're non-smokers, typically the cost is quite drastically less, non-smokers and in good health, because the bank is using something called a blended rate. And I'll share a little slide at this time as well of the difference between a mortgage rate and a healthy rate. If you're an unhealthy smoker, it's possible you have a really good rate with the bank or lender, and I have seen those situations. Or with CIBC, they have a Forever Young product. Occasionally it makes sense to keep that product. 95+% of the time it does not, and sometimes even as a smoker you're better to get a better product. The way the medical questions are asked as well is not by someone who is licensed. So there's been some problems related to that. I'll share again the CBC documentary, marketplace documentary on the mortgage insurance. And what they touch on is really that the questionnaires they give you by someone unlicensed and they're getting compensated typically can be fraught with problems. And I would recommend, if you have mortgage insurance with the bank, get your copy of your health application. Yes, you do have a copy of the questions you've answered. I've seen clients who should never have been approved. The bank won't pay it, but they're collecting a very high premium. I've also seen with a bank seniors being told they have to have the insurance with the bank. You do not have to have the mortgage lender insurance. It is good to have. You do not legally have to have that insurance. So just roll back to scenario A and B. Scenario A, my wife and I purchased critical illness and life insurance with the bank. I get sick before I die. They pay off the mortgage. I die. There's no payout for my wife. Let's say we have children now. And then now she's left with no life and no critical illness insurance. Obviously, my death and sickness has been hard on her, so perhaps getting life and critical illness insurance after you've lost your partner is not the best time. It's not something I recommend is when you want to go buy it. The other thing just to mention to you is in scenario B, where we own the privately owned insurance, is we could potentially have 4 payouts, where payout 1 is the payout of my critical illness insurance. Payout 2 is me passing away, paying out the $500,000 balance. Payout 3 could be my wife getting sick and having that critical illness insurance pay out to her. And then payout 4 could be if she happened to pass away and that life insurance pays out. That would be 4 policies under the same umbrella that would be a catch-all with the bank. So if the bank or lender, we had mortgage life critical for husband and wife, anytime that debt is paid off or the claim is put in, essentially, then that claim is going to be singular. There really cannot be, unless someone would like to correct me if you're I do not mathematically see how you could ever have 2 claims on a bank policy. The other thing, just to touch on very briefly, is inside of the mortgage lender insurance is also occasionally a disability component. Disability, which is sold as an income wage loss replacement plan. What that is not doing is giving you income to live on. That will cover, in most cases, and again, I speak to one of the big 5 banks, they will cover up to $2,000 per month for 24 months following a big disability that lasts more than 60 days. So the maximum that could ever pay out on your disability policy may be $48,000. That is not a whole lot of money to have. Like, that's the most it could ever pay out, because it's a two-year payout, versus a private disability that would pay out until you're age 65. The younger you are, the bigger of an impact that could have. Now, very briefly, because I need to keep these videos to around 15 minutes to keep your interest, is there's also insurance that you will get when you purchase a boat, purchase a snowmobile, sometimes on your credit card, and also for my corporate clients when we're making big purchases or big loans. So I've come across some very smart, very lovely individuals who went into the bank. They had to borrow money for their corporations, and they were paying $300 to $400 a month in lender insurance, which they could have privately and typically cost less and have a few of those benefits. The second thing that happens with seeing a person, an individual who is a licensed insurance representative, they will perhaps give you more options, and possibly things like whole life insurance, where if you're in a business situation that's growing, or in a family where you know your net worth is going to be much higher later on and you're going to have tax implications, there's some seeds that we can plant, just like a farmer, just like an apple tree farmer, that we have fruits that can come later on that are not going to happen when we have the mortgage with the lender or the bank. The other thing that is problematic with corporate and individual loans with the bank or lender is, let's say your term is up and you want to change lenders and your health has changed. You have to do a new questionnaire, which may be every 5 years, and you re-qualify for the life insurance, which means new underwriting. And that's post-claim underwriting with the lender insurance, not upfront underwriting, typically was what you have privately. So we have cost savings, we have more coverage, we have more robust offerings to be able to give you a better planning breadth moving forward. We have just an overall better situation that you will have with having mortgage or lender insurance with the bank. Now, I've chatted with people and 5 years has gone by and they've called me. I haven't talked to them in 5 years. They said, Josh, that mortgage insurance, lender insurance, we don't want it. And they recite almost everything I've said to you in this video. And what's beautiful is how they've remembered it and how accurate it was. So I hope 5 years goes by, you look back to this video, you're renewing your mortgage, you're a senior, you're being told you have to have this. Call me, email me, pop into our office. Doesn't matter if you're in another province. I will set you up with someone who will take care of you. I'll do my best to do that. We don't have a lot in this world, but I have you and you have me, and that is fantastic. Thank you for joining me today for our information session on mortgage insurance versus lender insurance. And again, this applies with corporate and individual mortgages, condos, pretty much anything that you have a loan attached to. Have a peek. See if you're paying a fee. Give me a call, shoot me a text, send me an email, drop me a comment. Love to hear from you guys, and keep helping the world. Thank you.